Hi, I'm Chuck Gibson. This is Taking Stock with Art Jarvis, a bi-weekly discussion of what is happening in the economy, the world of finance, and personal investment with Art Jarvis. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Now here is Taking Stock. Welcome, Art Jarvis. Taking Stock, episode number 60. It's good to have you back again.
Good to be here.
Always, right?
Always.
And but today, we've been talking offline, and the people don't know. But so I'm going to ask you. So how are you?
I am relatively fantastic.
See, they don't need to know the rest of the story. But hopefully, whatever those little relative things are, those will clear up.
We're in good shape.
You'll be in even better shape.
Yep.
But running on fumes.
Just a little bit.
Okay.
Just a little bit.
You sound great.
Thanks. Appreciate it.
Great.
I think my voice is changing, but that's all right.
I heard it. What the heck?
Finally.
What the heck? Well, mom and dad have been waiting for that for a long time.
Yeah. Exactly.
So,
I'll let them know.
Oh, happy day.
Yeah, precisely.
Well, off we go into Taking Stock number 60, and there is, again, some stuff coming up and some things that have happened in the last 2 weeks. And then we didn't talk about this offline, so I'm going to kind of bump you with this one. Today is day 27.
Correct.
Isn't that great?
Getting close to 34. One more week.
Yeah, well, so, 27, add 14, we're going to be at 41 by the time when you and I meet again for Taking Stock episode number 61. But here we are at episode 60, there are 27 days, and I know that 28 days ago, we didn't think so.
Yeah.
Here we go, they'll take care of it.
Everybody's digging their heels in, aren't they?
Well, yeah, everybody... wearing a particular party coat, whatever that is. And that's a sad state of affairs. However, it has had little to none bearing on the market, yes?
If you didn't read the newspapers, if there are newspapers still, if you didn't read the news...
Loveland Beacon. Oh, wait, that's not a
digital.
It doesn't show up on your driveway. You have to go to lovelandbeacon.com.
That's right.
And then the first thing you need to notice is Jarvis Global Investments scrolling across the top. Thank you so much for your support. Yeah. But anyway, you were going to say.
No, I mean, if you didn't know we were in the shutdown, you would know. I mean, we're hitting new highs. We were here 2 weeks ago, and I think you said we were at
66.71.
Today we're sitting here at 68.75. So we basically we blew right on through the 6700s, which we were talking about. Okay, we started hitting some new highs, and then we almost blew all the way through the 6800s. When we first sat down here, we were at, I think, 68.88, so we were only 12 points away from 6,900.
Well, we keep pushing. You, Art Jarvis, keep pushing the envelope. Because you say, it's rolling along and it's going to go here. You're making you're forecasting these numbers, and they keep coming true. So, we have to say, you're just, based on your experience and knowledge over all these years, you know what's happening, and you just keep pushing it. So at the end of the show 2 weeks ago, episode 59, I said, well, hey, Art, I'm going to put you on the spot. When we get together in 2 weeks, are we going to be at 6,800? And you said yes.
I couldn't remember. I was affirmative about it. I can't remember what I said.
You were affirmative. And people try to call in with questions.
That's right. It's a
unbelievable.
Hey, next caller, I'm going to take your call.
Well, thank God we have the show's producer handling that and takes care of it. But nonetheless, so you said yes.
Yeah.
And here we are, 68.75, 68.80.
Yeah.
And just so you know, I'm going to prepare you. Mm-hmm. When we get to that final minute today, you've got the whole next 28 minutes to think about this.
Mm-hmm.
Yes, 7,000 or no. And don't answer that now, but I'm going to ask you that at the end of the show.
I got your answer.
Or you can just tell me at the end of the show without me asking. I bet you do. But anyway, so we might as well just keep pushing the envelope on the S&P 500.
Yeah, I mean, here's the thing that you know, in this business we have a number of sayings, right? One of them is don't fight the trend. Okay, I'm a big momentum guy, whether that's sports or whatever, and invest. I'm a big momentum guy, So don't fight the momentum, whether you think it should be there or not. Don't fight the momentum. The other thing is we are now basically in a declining interest rate environment, which is a change, right? We were in a rising interest rate environment, then we were kind of in a stable interest rate environment, but now we've already, it's a 96, 97% foregone conclusion that we're going to get a quarter-point rate cut tomorrow, after the Fed meeting. So there's another quarter, and they're already talking about the December, I think it's 9th and 10th meeting. They're going to do another quarter point. So you're sitting here looking, and you start to hear these conversations about, do you think it's a little overdone? It's a little overdone. Yeah, I mean, we're not cheap. Let's be clear about that.
Well, now, wait a minute. Don't fight the trend.
That's the thing. I can sit here, I think the beginning of this year, I predicted 7,000 on the S&P, if I remember correctly. If I'm, you let me know whether I'm right or not. But, so 7,000.
We'll review that in January.
But that's based on numbers.
Right.
This is where this is. I can come up with a range and say, and then I pick 7,000. Right. If I hit 7,000 exactly, that's an absolute 100% miracle. Right. But what that does tell me is we had a lot of room to move up. But then you take away the financial side of the equation, the economic side of the equation, and you bring the psychology side of the equation into it. You start to get to a point where you start getting fear of missing out. FOMO, right?
Right.
Fear. So all of a sudden, all these people have been sitting on the sideline thinking the world's coming to an end. They're watching the market go up double digits again this year, especially if you look from the bottom in April. We're way up from the bottom in April.
Well, just the S&P 500, and as we talked about, you mentioned, just before we began recording the show today, 48.50 in whatever it was, April.
So we're up 2,000 points from April.
Yeah.
Right.
Right.
Math right?
Well, and what's funny is where were you mindset with the numbers? And I know because you made a forecast, but on January, whatever the first show was in January 2025, when we said, hey, what's the forecast for next year? Let's have fun with, Art's predictions for 2025. Right. And you predicted 7, and we were at the 4,000s. Let's say 5. 48.50. So
yeah, we lost
4,500 to 5,000, but you were going to add 2,500.
Right.
To go from 4,500 to 7,000.
I didn't have any idea we were going down to 4,800.
Right, because it was fine. It was all the way to what, 54?
Yeah, we were moving along, and February 19th was that top, and then we dropped 20% off. Yeah. But the point is you start to get the investor psychology in there, and again, you want to take some classes. Some of the classes I enjoyed the most in college were behavioral finance classes.
Right.
Because the market's driven by numbers sometimes, but much more often is being driven by psychology. Is people's
the two words that replace the one word psychology are fear and greed, and that's people's behavior. Right?
You got it 100%. So now you've gone from fear of going into a recession, fear of hyperinflation because of tariffs, the fear of a recession because of tariffs. None of that has come to fruition. Right? Now we're moving into fear of bad things to now I'm afraid that I'm going to miss out. And guess what? You've already missed out on, you've already missed out. If you're not in there, you missed out on a big chunk.
I hope the people who were listening took heed of those words from you. Don't, when you're afraid of missing out, you're already too late.
Yeah.
It's going, you're too late.
Yeah. People will. Yeah, I think I've used this before, and I'm not going to get the numbers exactly right, but let's say the average mutual fund does like 8% per year. Well, the average individual does like 2% per year because they're constantly getting in at the top and getting out at the bottom, right? So that's if you just generally stick with the plan, which we've talked about a few times, you end up better off. But yeah, I mean, at this point, we're getting to the point now, depending on how the earnings numbers change, that, I start to put brackets around things. And if the market wants to keep pushing things up, that's fantastic. I'd much rather hold on to something as opposed to trying to go find something else.
Right.
But I would move the brackets. If they want to keep pushing that stock or that sector up, that's great. I'm just going to keep moving the bracket up. And then if we bust through the bottom side of that bracket, I'm going to take some profits. That doesn't mean I have to adios the whole thing. But, take some, and then try and go find something else that has a higher percentage probability of making you money and, is also more reasonably priced. I'm still a growth at the right price investor. I want growthy companies, but I want to pay a reasonable price for them. If you're trading at 22, 23 times earnings, it's starting to get up there. Okay,
yeah.
So,
Well, I think that the toughest lesson that you share for people to follow, and I was a little harsh on them a moment ago, said, hey, hopefully you took heed to the words we've shared, is, don't get in when you see it's climbing, get in before. So that toughest lesson, to the point I'm trying to make right now, is when the market's down, buy in. Right. Look at, and I've been around a long time, and, a couple days, at this point in my life, I've been around a couple days. I don't think anybody has said it better in terms of that I've been around and talking about investing than it's a sale.
Yeah, 100%.
When stocks are down, it's a sale. If again, the example you use, like, hey, if you're watching television and it says, the local Target store or whatever has a big sale on whatever, you're like, oh, I gotta go get that now. Because it's 20% off.
That's right.
When the stocks are down 20%, guess what? Yeah. Get them now.
Sure.
But that is hard.
Yeah, and the problem is people worry that, okay, we're down 20%, but what happens if we're down 25%? I look at it like, I don't care. Like, if I can get a bargain that's 20% off, maybe it does go down a little bit further. But the same as hard as it.
Well, then you hold on. But you hold on then.
Yeah.
Don't sell it while it's dropping. Right?
Yeah. I mean, it's as hard as it is to try and pick a top number, it's also just as hard to pick a bottom number. Well, where's this going to? Again, you got investor psychology. People start panicking. People start capitulating. People throw the baby out with the bathwater. whatever phrase you want to use. 20% down can quickly become 30% down if everybody capitulates, right? But at least I got in at 20% down.
Right.
So, I can sit here and I can say, based on economic numbers and based on this and based on earnings and based on interest rates, we should be in this range, okay? And then in that range, I'll pick a number, okay? And it's the same thing on the downside. But again, I'll say one more time, if the investors, the psychology kicks in, that's a different animal, So people panicking is a very strong emotion. Let's put it that way. So, and then the other
that's why I was making a point. It's hard,
yeah.
It's hard to stay when you got a bad hand, and it's dropping. And it's hard to say I'm going to buy in while the market is dropping. And that's what did they teach you in that behavioral, finance or whatever, those behavioral investing classes.
Yeah.
That's apparently
they taught you that if you stay in, you end up better off than trying to get out. So,
that's the simple message.
Yeah. And the problem is that's great. And I've had this conversation in the past where things aren't going well. I mean, back in February, March, April of this year, we had this. I think we should get out.
Well, you know what the quote was from you?
No.
Then, because you'd made your forecast.
Mm-hmm.
And like you said a few minutes ago, I didn't imagine it was going to go down to like 48.
Yeah.
So I remember, whatever month it was, you said, can I revise my forecast?
Yeah.
That was the quote. That's going to be the 2025 quote of the year for Art. Can I revise my forecast?
Right. Well, everybody else revises their forecast.
I was going to say, what an investor didn't say, hey, can I flip this now?
That's right.
You know?
I don't like how that turned out. Can I change that?
Well, let me have that money back. I really didn't mean to invest in that one, you know.
But it's turned out great. You know, if we are willing to accept, in this case, 2 months of negative volatility, if you stuck with it, you're looking really good for 2025, right?
Right.
So that's why I keep. There are times. 2008 is a great example of, you know, we went into the Great Recession. That was the perfect time to alter the plan a little bit and go into protection mode. Okay, but generally that doesn't happen that often.
Well, to wrap up this portion of the conversation, do you have, I think you sort of explained it a minute ago, but do you have like a kind of a rule of thumb, you know, when you said trying to pick the lows is the same as trying to pick the highs. So when stocks are dropping, and it's like, when do I get in? Because I mean, where's that bot? Like you said, where's that bot? So I mean, for you, is there a specific strategy or kind of a rule of thumb you use? Like, if we said the stocks have dropped 10%, right, it's like, okay, now's the time to get in. Or it's like 10% is not enough of a drop for you to say we need to buy in. That's a good discount. Do you have a rule of thumb there?
Yeah, I mean, there's a couple things. You know, I do have the rule that never jump in front of a train rolling downhill. Okay, so if the momentum is clearly still continuing to head south, there's no reason. You know, generally speaking, you kind of usually run into a small base or something before you start heading back up. That's usually kind of a good indicator. The other thing I use is charting. Okay. So I will use charting to determine support levels and resistance levels and things like that. So if I've already made my decision that from a fundamental standpoint we're cheap,
right,
like we need to get in here sometime, and then I will start to use charting to say, okay, this is probably a pretty good spot to get in. Now, that doesn't mean it can't go just a little further down, but you look at this level, it's like that's probably going to be a pretty good support level based on what I believe with the fundamentals. So that's generally. But
it's not as simple. You're not looking at saying, you know, we're not jumping in when it's down 10%.
Yeah, it's just too arbitrary.
Like you said, the chart, at a certain point when it's like, hey, this is going to be a place we want to get in, or this is a stock we want to get in on, or whatever it is. And so you start charting it, you know, or looking at the charting of it to see.
Because I could have easily gone, well, we're down 5%, we really shouldn't have been down 5%, so let's go ahead and start getting in. The next thing you know, you're down 10%, and I go, okay, we really are shouldn't be down. And then we're down 20%, and I think you used the word, we're in the land of ridiculousness at that point, right? But who am I to tell you that, you know, just based on what's going on and investors panicking, that it's not going to go from down 20 to down 25, you know? But I feel a lot better about myself if I bought something that's on sale for 20% off. You know, I'm willing to eat the extra 5% because then you end up toward the end of 2025 and things are looking really good. So, yeah.
Well, the hold on is tough, and so there's a strategy for you too. If something tumbles, you know, you made a decision, let's get in, and we thought we picked the right spot. You know, this is a good place, but then surprisingly, well, wait a minute, it shouldn't have dropped 10 more percent, or shouldn't have dropped 20 more percent. At what point, and what's the strategy to decide, you know what, we really need to, you know, we need to take the loss and get out of here.
Yeah. Because
we're just going to keep, it's not going to rebound or something. Do you have that kind of a strategy somewhere?
Sure, but that's when you're looking at the fundamentals. I mean, you know, 2008 was a perfect example. Things were going on in our economy and pricing of companies and things like that, interest rates, you know, just wasn't a good cocktail, right? It was like this, and literally it was 2006 to 2008, and I'm sitting there kind of scratching my head going, this just doesn't, I'm like, I'm not quite understanding what's going on here, and basically we were just giving money away to people.
Well, and you were still just a young whippersnapper in the business.
I was a younger whippersnapper. Yeah. I'm not sure I was young, but I was younger. It's you know, you have to look at the fundamentals. You have to look at the psychology. You have to look at the charting. There's so many things that I try and pull together. You know, I'm trying to make a good, educated, fundamental decision.
Yeah.
And then you start looking at some of these other things and say, okay, this is what you believe. Now, when are you going to pull the trigger and get back in? So.
Well, there was something else we were going to talk about.
Well, I will point out one thing that's interesting right now is, with the government shutdown,
right?
We're not really getting economic numbers. We're getting them, but for instance, we got the consumer price index number last week, and that was 15 days late. Okay, 10 days late. So even that, we got that one, but even that one was 10 days late, which, by the way, came in at 3%, which was better than expected, which is why the market took off like a rocket. But, but you still kind of sit there back and go, okay, one, are we going to get a number? Two, how believable is the number? And then when they do come back to work, number three, is there going to be a big revision because they're like, well, we didn't have all the data, we were kind of prognosticating where we thought we were, So that's other than that, you mentioned it that there just doesn't seem to be a big negative thing going on in the markets because of the shutdown. For me, the biggest negative is the lack of information.
Yeah.
So,
well, despite the questions which you just outlined that surround the the corporate earnings numbers that just came in, despite those questions, you had some interesting statistics about what those numbers were this time and how they compare to the general average.
Oh, true. Yeah, I mean,
So I wanted to touch on that a little bit.
Yeah.
So those were some interesting numbers.
As of this week, 29% of the S&P 500 companies have reported earnings. 87% of those reports so far have been positive earnings surprises, which is a big number. Like that, matter of fact, so I think I mentioned to you, if that continues, 87% will be the highest positive surprises we've ever had.
Yeah.
So and when we talked 3 months ago, when we were looking at second quarter earnings coming out, we were in the 80%. So the average for like the last 10 years or 5 years, is 75 to 78% positive surprise. Last quarter, we were 80 something. Like 82, 83. Okay.
Right.
This quarter so far, we're at 87. So it's interesting. Number one, that shows me that the economy is stronger than people think it is, and the companies are doing better than they think they are. But the people who are doing the estimates and doing the analysis seem to still have a more negative outlook than what seems to be true out there. So when people come to me and say, we're hitting new highs, do you think we need to start getting more conservative? I'm like, well, number one, we got momentum. Number two, we got a declining interest rate environment. Number three, earnings are fantastic, right? So great earnings, lower interest rates, and guess what? Yeah, I'm happy with that. That works.
Yeah. That's almost like we like to end the show on high points. Mm-hmm. We're a little early to end it.
Are we?
That's a good spot, right?
That's a first.
Let's come back to that in about 5 or 8 minutes from now. What can I tell you? Yeah. Great, good job.
No, thank you.
All
right,
you want to talk sports for a
see,
bit or something?
No, because there's nothing I want to talk about in regards to sports.
Well, you wouldn't be out, and you're going to think this is funny, kind of. Now, you wouldn't be the only Ohio State fan. So if you want to say something positive in the sport, we won't do it. But anyway.
I'll give credit where credit is due. I'm keeping a close eye on Indiana. Indiana's looking good. So
we did veer off into sports
just a little bit. That's as far as I'm going with it, though.
Okay. We are in agreement. I don't want to pat myself on the back, but there are some people you could ask. But I said Indiana before the season started, just so you know.
Yeah, they just rolled over UCLA. Yeah.
Yeah, I stopped at the end of that one and said, is UCLA just really bad? Mm-hmm. But, and that's not to take credit because we know Indiana is really good. Yeah. And for the listeners who aren't into that, but it was 56-6 final score.
Right.
Indiana over UCLA. And we all know, you hear UCLA every year, and year in and year out, that's a great college football program. Indiana, not so much. So 56-6 over a program that's always been strong, that's a statement.
Indiana's confused. Because Indiana they think they're a basketball school.
Right.
But now they're wondering, like, maybe we're a football school, so they don't know what to think about themselves.
Anyway, that we veered off on.
Yeah, we went way off. So,
but
talk about momentum. There you go.
Right.
Talk about momentum. There, once again, there's a perfect example of a team that has some great momentum.
Well, and that's, you know what, and it's not that big a thing for me to have said something before this season started, because I was looking at what they did last year, what they had coming back, and what this coach is developing there in terms of, a culture within the program. Anyway, so, that's the word, big momentum from last year to this, and it's just carrying on as the season goes on.
You scared me when you said Big Mo, so I was worried about where you were going with the Big Mo comment.
Okay. Anyway, I just think here's the other side. We talked about, and I said it first, was the little to no impact because of the government shutdown. If the government shutdown continues, how long does it take? Because there has to be an impact. At some point, there has to be an economic impact. Mm-hmm. And so the numbers, we just talked about, 87% of those are reporting a positive surprise.
Right.
That's huge. Do you, and this is just like a speculative question, do you have somewhere in the back of your head, like, it's going to catch up with us, this government shutdown? What do you think?
Yeah, I think it would have to go on much, much longer for me to start worrying about that. I mean, and we mentioned this once before, it's what might be different about this time is some people might not have jobs when it's all said and done, right? Whereas in the past,
right,
you come back to work, you get a great big huge check for the days that you weren't paid for, even though you weren't working. You get it, that money goes back into the economy and things like that, and whereas in a short-term shutdown or in a shutdown, you come off of trend a little bit, but pretty quickly you come right back to trend. Yeah. So this would have to get way more ugly. But the other important thing to remember is we have a substantial amount of United States debt that we need to pay on, right? Well, we need to make our bond payments and our interest payments and all that stuff too. So that's the bigger thing for me. It's like, we can't technically default on what we owe everybody, right? So that would be not a good thing. But I'm going to go, naive Art is that they wouldn't let it go that far. So I've been wrong before.
It's like you almost don't want to say that. I'm sitting across from you. People can't see, but got the finger on the lips saying, "Shh, don't say it." I don't want you to say that just for that very thing. And I don't really think you're naive, but I think that we don't. I think that we all are. I don't think you're naive, but I think we all are, because I don't think we can even possibly know, and this is terrible, but it's true, how deep the hatred is for Donald Trump. And because this is politically driven, there is no good reason for the government to still be shut down, and the two sides to be two sides. Okay. We should be one government, regardless of your political, ties, party ties, when it comes to this. Yeah. And so I think that's where we're naive, is to think that is not so deeply rooted in, the division of the two parties right now. Yeah. To be as kind as I can.
Yeah, I think it was the governor of Utah, and I can't remember his name off the top of my head, was out there, and he has supposedly been making a pretty strong push to kind of mend some fences and bring both sides together and things like that. And I think it was on 60 Minutes where I was watching, and they were talking to him, and he made the comment that he talks to other congressmen and both sides of the aisle, and their comment to him is, "We appreciate what you're trying to do, but it's too late." And that's a quote.
Yeah.
When you got congressmen talking about not only are we not trying, it's too late. We're done trying. It's like, okay, that's not a good thing. So
well, that's why I say that's where our naivety leaves us, is not understanding just how deeply rooted the division is at this point.
Yeah.
So we got about a minute.
Okay.
So I told you I was going to.
No, here it is. You left 1 minute just for that question.
Well, I'm going to ask you two, and that's going to be the last one. But the first one is, so is there anything else?
Nah, not yet. It's we're still plugging along. No, go ahead and ask your question.
No, we want to lean into a positive finish. Yeah. So, and it's pretty simple. Mm-hmm. S&P just continues to climb. So, the question I promised for everybody that heard us earlier, and now here we are. You've had a chance to think it. I know you didn't have to think about it much because you already knew what you were going to say. Yeah. So, I'd like to twist the question just to mess with you, but I'm not going to. Mm-hmm. It is 14 days from now. Is S&P over 7,000? I
believe it will be. And
that was too easy.
I know. Well, here's what's going to happen tomorrow.
Where's the Dow Jones Industrials going to be?
It's heading for 50,000. So it crossed into new highs this past week too. Got above 47,000. The Japanese and Nikkei is hitting all new time highs. There's a lot. I mean, it's not just the U.S. There's a lot of international
around the globe.
Well, they're hitting new highs. So. Matter of fact, the international index has actually done better than the U.S. index in 2025. So here's my reasoning being. So tomorrow, generally, so they're going to cut rates a quarter point. We're going to go hem-ha. We got what we wanted. Okay, now what are you going to do for me, right? So the market will probably go up. And then it will go down, and I'm talking in a very short period of time. And then we will start heading up again, because the next conversation is going to be that we're going to cut rates in December. So I could easily see where we could add enough 100 and whatever that is, 125 points in the next 14 days to get to 7,000. So my point is, if we hit 7,000, in no way, shape, or form would I be surprised.
Perfect.
Yeah.
All right. And that's a good thing.
Yep. That's a great thing. My normal caveat is as long as nobody does anything stupid. Yeah. But, can't control stupid much. So,
I think, well, as always, thank you so much.
Yeah, thank you.
For being with us. But I think today was as good a show as ever in terms of offering some insight to the people and, how they should be making decisions, when to get in and why to stay in. I'm not even going to say when to get out. Yeah. It's when to get in and why you should stay in when things seem like might be a little precarious. Yeah. And wow, this year, it's going to be November in a minute.
Yeah, it is.
We got like 60 days left in the year, a little bit more than that. But as we wrap up, Taking Stock episode number 60, Art Jarvis, again, just thank you so much for being with us.
Mm-hmm. Appreciate the opportunity. Good to see you.
All right, and we will be back in 2 weeks. Until then, thanks for listening. Thanks for joining us for this edition of Taking Stock with Art Jarvis. Join us again in 2 weeks for our next edition. Taking Stock with Art Jarvis is a presentation of Loveland Beacon in partnership with Jarvis Global Investments, LLC. Jarvis Global Investments, LLC is a registered investment advisory firm. The advisor is not attempting to furnish personalized investment advice or services during this production. Individuals should fully investigate the appropriateness of any investment before investing. Past performance is no guarantee of future results. Investments may lose value.